All right, let's jump right in. Today, we're taking a look inside the latest quarterly results from Aztech Global. Now, if you just glance at the numbers, things might look a little rough. But if you dig just a little bit deeper, a completely different story starts to take shape. Okay, so here are the headline numbers. And yeah, they definitely paint a challenging picture. For the first 9 months of the year, revenue took a hit, down almost 41%. And net profit? Wow, that's dropped by over half. Look, we're not talking about a small dip here. These are big, attention-grabbing figures that make you ask, what's going on? And that leads you to the big question, right? When you see numbers like that, you have to ask, is this a red flag? Is the company in some kind of trouble? Or are we just seeing the messy middle of a bigger, smarter strategic change? Well, that's exactly what we're going to figure out. So before we get too far, what does Aztec themselves have to say? Well, they're pointing the finger at one main thing, just lower demand from their customers. This suggests it's more about the whole market slowing down, not some kind of internal meltdown. But, that's really just the beginning of the story. Because honestly, those big revenue and profit numbers, they don't tell you everything, not even close. To really get what's happening, you've got to look past the headlines and check out the company's financial health. And that's where the picture gets, well, a lot more interesting. Check out this number. This is what's really fascinating. Even with sales down, Aztec is sitting on nearly 230 million Singapore dollars in net cash. I mean, that is a serious war chest. It's a massive sign of just how strong the company's foundation really is. And if you're wondering why that's such a big deal, think of it this way. Net cash is the money a company has left over after you pay off every single one of its debts. It's pure financial firepower. Having a ton of it means you have the freedom and the stability to get through tough times or to pounce on new opportunities without borrowing a dime. And get this, it's not like they're just burning through old savings. In the first 9 months of this tough year, they actually made $14.5 million in positive free cash flow. That means their core, day-to-day operations are still bringing in more cash than they're spending. That's a sign of a really healthy business. So, what's the big takeaway here? It's that classic saying, right? Don't judge a book by its cover. The cover, the sales numbers, looks a little worn, but the foundation of the company, its cash, its balance sheet, is incredibly solid. And that strength is what gives them the power to make some serious moves. And they are absolutely making moves. This strong financial position isn't just for sitting back and waiting. Nope, it's fueling a very deliberate, very strategic pivot. So let's look at the actual plan they're putting into motion to deal with that weak demand and build for a stronger future. First things first, they are not putting all their eggs in one basket anymore. They are aggressively going out and finding new customers. And they're making real progress. This year alone, they've landed 11 new customers and locked in 22 new projects, pushing into really exciting areas like medical tech, industrial gadgets, and even the auto industry. And we're not talking about small, simple stuff here. We're talking about some seriously cool, high-value tech. Things like medical-grade heart monitors for babies, 3D navigation devices for surgeons, and then, on the other end, an AI-controlled cat flap. It really shows they're moving up to making more complex and hopefully more profitable products. But the plan has two parts. It's not all just about chasing new business. At the exact same time, they're looking inward and making their own operations leaner, smarter, and just more efficient so they can squeeze more profit out of everything they make. And here's a perfect example of what that looks like. They're right-sizing their factories. They sold a big building in China and are now just leasing back a smaller, more efficient part of it. They're also selling a facility in Malaysia. It's such a smart move. It frees up cash, slashes their overhead costs, and makes sure their physical space matches what they actually need right now. And, the company's CEO, Michael Munn, really hits the nail on the head here. He's not ignoring the challenges, but he's pointing to all these smart moves as proof that the company is resilient and focused on the long game. It's a story about being proactive, not just reacting to bad news. Okay, so they've got a rock-solid bank account and a clear plan they're already working on. So what does all that mean for the future? Let's take a look at what the company is saying officially and what their biggest priorities are moving forward. Now, you know how these official statements are. The language is always a little careful. They're saying they're cautiously optimistic, given everything going on in the world. But here's the key line. Unless something totally unexpected happens, they still fully expect to be profitable for the whole year. And this right here, this is their playbook for making sure that happens. It's a 6-point plan, and it's super comprehensive. They're focused on everything from getting more customers and suppliers, to making the most of their factories in China and Malaysia, to boosting their R&D, all while keeping a super tight grip on their finances. It's a total strategy for building a stronger, more bulletproof business. Which brings us right back to where we started. We saw some pretty tough numbers, but what we've actually uncovered is a story of incredible financial strength and really decisive action. So the question isn't about survival anymore. The real question is this: with all that cash and a clear plan, can Aztech use this slow period to reinvent itself and turn these market headwinds into a massive tailwind that pushes them into their next phase of growth? Now that is the real story to watch.